CNBC TV 18, celebrating 16 years of business leadership.
Hello and welcome. You're watching Taking Stock on CNBC TV 18. I'm Ekta Batra. With me is Anuj Singhal. Anuj, it turned out to be quite an interesting week. We had a lot of events this week. We started with the CPI data. Then we went on to the Fed. We had news on diesel from Delhi. But through all of this, the markets were extremely resilient except for the last trading day. And we managed to gain quite a bit even in terms of the mid-cap outperformance.
Yes, so I think what really stands out, Ekta, is that the mid-cap outperformance clearly was the big factor, and that's telling you a thing or two about the market, that all through the year this has been a bottom-up stock picking market, and that's going to continue well until the maybe new year, maybe even the first 2 quarters of new year, because nothing has changed for the market to change that. What Friday may have done, though, is it would have hurt the bulls a bit, because you reclaimed or you gave up all of Thursday's gains, nearly 90% of Thursday's gains. It didn't look like just a pullback. So that's something that I'll be watching out for next week. If during the next week at any point you give up the weekly gains of this week, then I think you're looking at trouble. Then you're looking at maybe a bad expiry, maybe even closer to the recent lows. But if next week the market is able to move on, then I think you'll say that, okay, the market has made a bottom and you're ready to move on. But within that, it's going to be again stock-specific stories, and mid-caps are again going to outperformance. That's my sense looking at the trade. So that's for the week. But joining us on the show today then are Manish Gunwani, Deputy CIO Equity at ICICI Prudential Mutual Fund, and in a bit we'll also get Arun Baid, Vice President Research at Religare Capital Markets, for some individual stock ideas. Manish, good to have you on the show. First, a word on the way the market is set up after the Fed event. Do you think we have made a bit of a durable bottom and we can move on, or do you think the market can still seek lower levels?
Well, I think a lot depends on how the whole configuration of dollar and commodities move. I think globally we've reached a point where deflation is a big worry. And we've seen crude make a new low, and dollar still seems strong even after the Fed meet. So I think what needs to happen for healthier EM markets is a change in the trajectory of the dollar and commodities. We do need to see some inflation coming back in commodities, because the almost vertical fall in large markets like oil, what they do is kind of threaten macro instability, because obviously you will have a lot of economies which are oil producing undergo a lot of stress, and if dollar continues to appreciate, there is a mountain of dollar denominated debt in the world which will be under stress. So I think a durable bottom would probably be made when we see a certain amount of inflation in commodities and a stability in EM currencies come back.
Okay. Manish, hi. Good to see you in today. Well, just taking that point about commodities forward, one of the things that stood out during the week was the mid-year economic review, where the fiscal consolidation, which was stated, might in fact be something of a challenge in the coming year. Your sense in terms of whether that would eventually weigh on the markets if in case the fiscal deficit target is not met by the government, say in FY17 and not FY16?
I think fiscal deficit is one of the more important economic parameters, definitely, and I think it kind of ties in with what I was saying, because even if you see how it's shaping up in India, the challenge is now the nominal growth. So one of the reasons I think we will see some challenge on the fiscal front, in spite of the government doing a lot of good things, for example, they've raised excise revenues, and indirect taxes, to my mind, have actually been very buoyant given the commodity prices. So in spite of those benefits, what is happening is you have such low nominal growth, which affects both the numerator and denominator, in the sense that your taxes are eventually linked to nominal growth and your denominator is your nominal GDP. So I think, as I was saying, basically the world needs to have higher nominal growth at this point of time. And if that doesn't happen, you will see problems in China, you will see fiscal deficit issues in India, etc. I think they all come back to the same thing, that at this point, for a healthy global economy, you do need to see some inflation in commodities and some nominal growth.
Okay, but Manish, what should be the portfolio approach from here on? We are almost at the year end. Look at the Nifty and Sensex would say that it was a big down year. But if you take a look at some of the mid-cap funds or take a look at some of the mid-cap portfolios, they have done extremely well. Do you think that kind of trend is going to continue?
Well, I think obviously a lot of bottom-up stock picking helps in mid-caps, but I guess it's also driven by the fact that if you see the mix of flows, the FI flows have been quite muted and the domestic flows have been pretty strong. And the domestic flows, the proportion going into mid-caps does tend to be much higher. So the outperformance of mid-cap versus large cap, I think a large part of it is just also driven by this mix of flows. Now, going forward, from an overall sectoral perspective, I would think that today we are in a market where because defensives have done well over the last 3 to 5 years, and the Indian macro by itself is looking quite okay, there is a chance that domestic cyclicals may outperform, but obviously you'll have to kind of choose stocks which at this point don't have probably a lot of exposure to the global economy, because that is where the deflation is coming from, that is where the stress is coming from. So I think it's going to be very mixed. I don't think a pure quality portfolio, for example, would outperform a lot. Neither would a pure cyclical or leveraged company portfolio would outperform. It's probably going to be a mix of these two.
Okay. Manish, what is your sense in terms of the banking space? We saw the marginal cost of funds, the final recommendations which came out from the RBI this week, and that's expected to be much more detrimental in terms of floating rate banks, which would be more PSU banks, but the impact on the net interest margins are not expected to be as much as the draft recommendations. Would you be a buyer into PSU banks in this context?
So I think while this marginal rate thing is important, but I think at this point of time, if you look at corporate lenders, both private and PSU, the main issue is actually asset quality, and I think a lot of focus will be there. And that, if you split into two halves, one is issues related to the domestic side, which is infrastructure, power, etc., and two is issues related to global cyclical sectors like steel, aluminium, etc. Now, if you look at these two segments, obviously the first one is on the mend, because you're seeing a lot of policy, a lot of things being done by the government to alleviate the problems there. The second part is a relatively new development over the last 6 to 9 months because of the almost vertical fall we've seen in commodity prices. I guess our approach to banking, specifically for corporate lenders, see, the retail banks are doing fine. I mean, the consumer in the Indian context is relatively unleveraged. There is no issue of very high debt to income or anything of those parameters on the retail side. On the corporate side, what we need to monitor is how asset quality pans out within these two segments.
All right, Manish, thanks a lot for your time today and enjoy your weekend. So that's the fundamental call on the market. We'll do one thing, we'll take a break on that note. But as we do that, let's listen into some market opinions. Once we come back, we'll get you some stock ideas from Religare.
The key problem for the Indian industrial sector is that its inflation rate is -4 if you look at WPI, which means real interest rates are 10%. And when they're that high, you're not going to get any capex in India. I think if we get an environment in which the RBI begins to cut interest rates, maybe some point in the second quarter, you get a more fiscally effective government as these projects start to get executed, then India should perform very well. And I'd be very comfortable with India giving a 15% plus return over 2016.
First quarter percent hike suddenly making people move from emerging markets to developed markets as if we did not know that the US economy was doing at least this well. They are not saying it's doing very well. They are doing it's okay, which broadly the whole world knew. And the US market anyway has been doing very well and deserves to do well. But I don't think this makes people move from emerging to developed markets. India is today, I think, in a great place because finally there are going to be changes on the ground.
We expect that the market would consolidate and show probably some upside over a period of time. I think the biggest challenge has been the earnings growth for the Indian companies has been below expectations. For long-term investors, it should not be because GST is something that will deliver better growth and tax compliance for a period of time, not necessarily on a one-year time frame. And also some delay shouldn't have a big impact on the fundamental value of stocks.
The fundamentals are reasonably strong to see some positive returns in the next calendar year. 20% for now, but looking at our assumptions, particularly on commodity prices, profitability for the cement sector, revenue growth for the industrial sector, I think there will be some earnings cuts over there. So if I just transpose the current spot prices, commodity prices, and then look at earnings growth numbers, I think it's more like 15% for now.
I'm still holding the view that 7,500 to 7,530 should hold as a support. And there is, of course, risk-off approach to all markets right now. I think this particular week will encapsulate a lot of volatility around the globe. 7,500 should not break. Right, because we looked at the quarterly chart of Nifty on the log scale, and on the log scale for Nifty quarterly chart, 7,500 is looking like a very important support. We believe that the pattern is indicating a consolidation, a sideways consolidation, on the back of which there could be a bounce back from this particular support.
CNBC TV 18, celebrating 16 years of business leadership.